We sign contracts for everything these days, don't we? Like streaming services, gym memberships. But what about those contracts that are supposed to protect us when things go wrong? Insurance. I mean, do we really know what makes those promises actually binding?
You're right. Insurance is a huge part of our lives. I mean, it's supposed to be there for our biggest assets, our health. Well, in this deep dive, we're going to look at the core legal ideas behind every insurance contract. Think of it as a crash course.
Exactly. We've got some amazing insights to really dig into what makes an insurance policy actually legally sound. So we'll break down the core elements of a contract, any contract, and then we'll look at the unique things about insurance contracts, and then we'll even look at how these policies come about and the role of everyone involved.
Yeah. Basically, we want to give you a good grasp of insurance law. No more mystery around these terms and principles, so that you can feel confident about your insurance coverage.
Okay, let's start at the beginning. What even is an insurance policy? Well, basically, it's a contract. It's a legal agreement, right? Between you, the policy owner, and the insurance company. And they're making a serious promise to pay benefits if certain things happen, as laid out in the policy.
Right. And to make that promise actually legally solid, there are four ingredients that have to be there. These are the cornerstones of any contract, and we can remember them with a little mnemonic. CLOC.
CLOC. Okay, I like that. So the first C is competent parties. And this isn't about the company's customer service or anything. Legally, it means that both sides, you and the insurer, can legally enter into a contract.
Exactly. So for the insurance company, this usually means they're licensed. They're allowed to operate where you live. And for you, the applicant, well, generally it means being an adult, that legal age of majority and being of sound mind. You also got to be making the decision freely, not being forced or anything, and not like super drunk or high when you apply.
Right. And the stuff we've looked at actually points out some specific cases where someone might not be legally competent. Minors, although sometimes there are exceptions, for necessary things, and individuals who are legally considered mentally incompetent, people who are seriously under the influence, anyone being forced into a contract.
Yeah.
And even categories like enemy aliens or people with certain convictions, depending on the state. That's quite a list. And here's a key thing. Even if it's, say, life or health insurance for you, if someone else is buying the policy and paying, they're the policy owner, the one making the contract with the insurer. Imagine, say, someone trying to take out a policy on, like, a relative with severe dementia. That policy might be challenged later because of this whole competent parties thing. It really matters.
Absolutely. The policy owner is the one who can make changes, use its benefits, because they're the ones with legal standing. They provided value. So the L in CLOC is for legal purpose. This is pretty simple with insurance.
Yeah, any contract has to be for something legal, right? Not against the public good. You can't have a contract to, like, smuggle something. And thankfully, insurance contracts are all about a legal purpose. They're a protection from real risks.
Okay, moving on. The O stands for offer and acceptance, or just agreement. Both sides need to be on the same page. In insurance, it starts with you, the person wanting insurance, making the offer.
Right. And you make the offer by, well, filling out that application, all those questions about your health, your property, whatever you're insuring. Oh, and there's a crucial part, setting that first premium payment. If you don't, it's more like you're asking them to make an offer to you.
That's so important to remember. Once they get that complete offer, the insurer has a choice. Accept it,
Well,
usually by issuing the policy, or reject it, based on their underwriting, their assessment of the risk. And from what we've read, the agreement is actually final when the insurer issues the policy, or even when their agent hands it to you. That's when both sides have clearly agreed.
but what if the insurer doesn't like your offer? What then?
That's where we get a counteroffer. If the insurer says, hey, how about a higher premium, or we'll cover this but not that, well, your original offer is off the table. No contract exists unless you accept their counteroffer, usually by agreeing to those new terms and paying that new premium. So it's a bit of a dance back and forth till both sides agree.
It makes sense. So we've got competent parties, legal purpose, offer, and acceptance. What's the last C?
That's consideration. It sounds formal, but the idea is simple. It's the exchange of value. In any contract, both sides have to give something to the other. In insurance, your consideration as the buyer is the premium you pay, plus the stuff you say on the application, your representations. You're giving financial value and info about the risks.
And the insurer, what's their part of the deal?
Their consideration is their promise to pay if a covered loss happens while your policy is active. That financial protection is what you're paying for. And what's interesting is that to keep the coverage going, you need to keep making those premium payments. That's in the policy too. So the consideration part is ongoing.
So it's a cycle. I pay, they promise to cover.
Okay.
Now, insurance policies have some really unique quirks. What makes them different from other contracts?
Yeah, these features really make insurance what it is. The first one is they're aleatory.
Aleatory sounds like chance or the unknown.
You got it. It means the potential exchange of value is unequal. It all depends on a future event that's uncertain. You might pay for years and never file a claim, but you could pay just a few premiums and have a huge loss, getting way more back than you paid in. It's the risk, like disability insurance. You pay hoping you never need it. But if you become disabled early on, those benefits could be way more than your total premiums.
Like life insurance.
Mhm.
Someone pays a little, then boom, unexpected death. The family gets a huge payout. It's that uncertainty, that potential for things to be very different in terms of what's paid in and what's paid out that's aleatory.
Exactly. The insurer's obligation to pay only kicks in if a loss happens, and the financial outcome for each side can be way different. Another thing is that these are contracts of adhesion. This means the insurance company writes the whole contract. You don't really get to negotiate. You get the policy, and it's take it or leave it.
So I can't haggle over wording or try to change things.
With most personal insurance, not really. And
Oh.
because of that, any vague parts, any unclear language are usually interpreted in your favor by courts. This is the rule regarding ambiguities. It's like, hey, if you wrote it, you better make it clear.
Yeah, that's fair. And that ties into the doctrine of reasonable expectations, right?
Totally. This is a court will interpret the contract based on what a normal person would expect it to cover. So even if the insurer meant something very specific, if a reasonable consumer would think it covers something else, they might have to pay. It's about fairness, stopping insurers from being too tricky with the language in these take it or leave it contracts.
Good to know. So if something's unclear and I understand it like a normal person would, I might actually be right. Okay, another thing is that these are unilateral contracts,
Mhm.
one-sided, right?
Yep. Only one party makes an enforceable promise. In insurance, that's the company, promising to pay for covered events. You don't actually promise to do anything, not even to keep paying premiums.
Hold on, I thought paying premiums was like the whole point.
It is. They can cancel if you don't pay, but they can't sue you for not paying future ones. Their promise is one way to pay if you keep up your end by paying. It's a condition, but not a promise from you in the same way.
Ah, okay, I see. So their promise depends on me, but I'm not legally bound to keep paying the way they're bound to pay if something happens.
Got it. What else is unique about these contracts? We have personal contract here.
Most policies, like car or home insurance, are personal. They insure the person, not just the stuff. So you can't just transfer your car insurance to the buyer when you sell the car. It's about your driving, your risk.
Makes sense. It's tied to me. But there was an exception to this, right?
Yeah, life insurance, it's not considered personal in the same way. You can usually transfer ownership. It's called assignment. Just tell the insurer and the right to transfer. That's why we say policy owner, not policyholder, with life insurance. They might not be the same person. Interesting. My house insurance is stuck with me, but my life insurance could go to someone else. Okay, another thing. These contracts are conditional, meaning
It means their promise to pay depends on you meeting certain conditions in the policy, like paying premiums on time. If you don't, well, they don't have to pay if something happens later. But there's more. You usually have to tell them quickly when a loss happens and give them proof of loss, documents, evidence. If you don't, they might deny the claim.
so it's not just the event happening. I got to follow the rules to make a valid claim.
Yeah.
Makes sense.
Right.
Okay, what about valued versus indemnity contracts? Sounds like two ways they decide how much to pay.
Exactly. It's about their approach to compensating you. Valued contracts pay a specific amount, no matter the actual financial loss. Life insurance is like this. You buy $1 million policy, that's what they pay when you die, even if the actual financial impact is different. AD&D, accidental death and dismemberment, is usually like this too.
So a fixed sum. What about indemnity contracts?
Those aim to put you back where you were financially before the loss. They cover the actual amount up to the limit, minus deductibles. A lot of health insurance is indemnity. They reimburse you for what you spent. Some disability income policies are like this too, replacing your lost income.
So valued is fixed. Indemnity is about restoring what you lost. Clear. Lastly, there's insurable interest. This seems crucial.
It is. It's having a financial, economic, or even emotional stake in something or someone. You have to have something to lose. This is to stop people from, like, gambling on others' misfortune and to reduce what we call moral hazard, the risk that someone might cause a loss on purpose if they benefit financially. You can't just insure a stranger's life.
Right, that makes sense.
Yeah.
So for life and health insurance, when do I need this interest?
You got to have it when you apply, like spouses, parents, and children. That's automatic. It's clear their life and well-being has value to you. It can exist in business, too. A company insuring a key employee, someone whose loss would hurt them. If someone owes you money, you can insure them to make sure the debt's repaid if they die. Interestingly, the interest only needs to exist at the start. So, say a couple divorces, but keeps the policies they got on each other during the marriage. Those are usually still valid, even though the reason for the interest is gone.
That's a key point. What about property, like my house? Same rule.
A bit different. You need the interest when you buy the insurance and when a loss happens. Can't insure your neighbor's house. You don't have a stake in it. You only have interest in your home because you'd lose financially if it burned down.
Makes sense. I have to be the one who actually loses if something happens. Okay, we've done basics and unique features. Now, how are these policies made? Our notes say the policy is actually several documents.
Right. Usually it's the main policy document, any writers or endorsements, which are like add-ons or changes, and a copy of your application. So that application becomes part of the contract.
And a big principle in this is utmost good faith. What's that really mean?
It means both sides. You and the insurer, gotta be honest. Open, you tell them all the important stuff. No hiding, no misleading. The insurer relies on you being truthful about the risk. And you rely on them to pay if you're honest. Like if you apply for health insurance and you forget to mention a heart condition, that's bad.
And there are three concepts tied to this: warranty, representation, and concealment. What's a warranty in insurance?
It's a statement you make that is guaranteed true. Every detail. It becomes part of the contract. If it's untrue, even by accident, they might void the whole thing. Warranties are serious. You see them more in, like, business insurance than personal policies.
So it's a strong statement. Its accuracy is vital. What about representation?
That's a statement, too, but it's true to the best of your knowledge at the time. It's not part of the contract. But if it's materially false, meaning it's a big lie, that would change their decision to insure you, or the price they might void the policy. The difference is certainty. A warranty is true, period. A representation is truthful, as far as you know.
Okay, so warranty is guaranteed, part of the contract.
Yeah.
Representation is a belief, has to be mostly true. What about concealment?
That's when you don't tell them something important, like hiding info they need to assess the risk. If you do it on purpose to get a policy you shouldn't, that's fraud. Even if it's not on purpose, they might still be able to rescind the contract, basically cancel it like it never existed. But they usually have a limited time to do this, like 2 or 3 years. After that, it's harder for them to void things based on this.
That's good protection. Now, there's a difference between void and voidable contracts, right? Sounds similar, but they're not.
Right. Void means no legal effect from the start. Like it never happened.
Yeah.
It's missing something essential, like a legal purpose. A contract to, I don't know, buy illegal weapons, that's void. No one can enforce it. A big enough misrepresentation could make an insurance policy void too.
Okay, illegal stuff is void. What about voidable?
That's valid, but one party can choose to end it for a legal reason. Like if you stop paying premiums, your car insurance doesn't just vanish. It becomes voidable by the insurer. Until they cancel it, it's technically still there.
Got it. Void was never good. Voidable was good, but can be canceled. Big difference. We also have cancellation, fraud, the parole evidence rule, waiver, and estoppel. Lots of legal terms. Let's do them quick. Cancellation seems simple, ending the policy.
Yeah, it's voluntary termination. You can usually cancel anytime. They can cancel too for things like non-payment or if the risk gets much higher.
Fraud is pretty clear too. Trying to trick them for money.
Exactly. Lying, fake claims, it's serious. They might deny the claim and rescind the contract. But there are limits on when they can void a life or health policy for fraud, usually after a few years.
What about the parole evidence rule? Sounds complicated.
Basically, once a contract's in writing, that's it. The written policy trumps any previous talk that's not in there. So if an agent says you're covered for something, but it's not written in the policy, well, that verbal promise doesn't mean much legally. Get it in writing.
So always check the policy. What's waiver?
That's when they voluntarily give up a right they have under the policy, maybe through their actions or what their agent says. Like, if your policy says it's void if you do some risky thing, but they know you're doing it and don't say anything, that could be a waiver. Or like something we saw. If they mess up and issue a policy even though your application was missing stuff, that might mean they've waived their right to deny a claim because of that later.
And estoppel, that sounded like they're stopped from denying something because of what they did.
That's it. It's a rule that stops them from denying a claim when they led you to believe you were covered and you acted on that belief. There are 4 key things for this. First, the agent said something inaccurate. Second, you reasonably relied on it. Third, they're now trying to say, nope, the policy says different. And fourth, you'd be harmed financially if they got away with that. It's about preventing unfair outcomes when you relied on them.
Powerful stuff. Okay, we've learned a lot about the contract itself. Now, what about the people involved? The law of agency. Who are the key players?
The main one is the insurance agent. They're authorized by the company to act on their behalf. They explain policies, help with applications, collect premiums, and provide service.
And they work for the insurance company, the principal, based on a legal agreement. That agreement says what they're allowed to do.
Right. And there's some big principles in agency law. First, what the agent does is seen as the company doing it. Second, contracts made by the agent are binding on the company. Third, money you pay the agent is like paying the company directly. And last, stuff you tell the agent is like telling the company itself.
The agent's like the company's face. Now, there are 3 types of authority an agent can have: express, implied, and apparent. What are those?
Express is what's written in their contract. Like it'll say they can solicit applications for certain types of policies. Implied is stuff they need to do their job, even if it's not written down, like printing business cards with the company logo.
So what's needed to do what they're allowed to do? What about apparent authority?
That's based on what you, the customer, see, based on what the company does. Even if the agent isn't actually allowed to do something, if the company makes it look like they are, they might be stuck with it. Like, giving someone rate books and applications makes them seem like an agent, even without a formal agreement.
It's all about appearances. Now, there's a difference between brokers and agents, right? They work for different sides.
Big difference. An agent works for the company. They have a contract with one or more insurers, and they can often bind coverage, finalize things. A broker works for you. They don't have a contract with any specific insurer and usually can't bind coverage. They're like a middleman helping you shop around.
So the broker's on my side, the agent's on the company's side. We also saw something about agent versus solicitor authority.
Yeah, in some places there's a difference. A solicitor can usually only find and sign up applicants. They can't actually finalize the policy. They're lead getters, basically.
Leads go to the agents, who do the real deal. Lastly, there's the agent as a fiduciary. What's that about?
A fiduciary is someone you trust with your money, basically. Agents handle premiums, give advice, so they're fiduciaries. They're legally and ethically bound to act in your best interest, to be honest, with any money they handle.
A serious responsibility. Okay, almost done, but there are some other legal concepts to touch on. First, subrogation.
That's the insurer's right to go after someone else who is really responsible for a loss after they've paid you. Say someone else causes a car accident, your insurer pays for your car. Then they might sue the other driver to get that money back.
So the one at fault pays in the end. Okay, then there's tort law, which is not the same as contract law, right?
Right. Contracts are about agreements. Torts are about civil wrongs. Someone acts carelessly and harms another person. Now, it's not directly about the insurance contract, but it matters for liability coverage. That's the part of a policy that protects you if you're the one who messed up and caused harm. The stuff we read mentions different levels of negligence, too. Simple negligence, gross negligence, and then there's willful or wanton negligence, which is almost like doing it on purpose, and that's usually not covered.
Tort law is the bigger picture of liability, and insurance is there to help with that. And last, we have insurance agent errors and omissions, E&O, professional liability insurance. What a mouthful. What's that for?
It's like malpractice insurance for agents. It protects them if they make a mistake that costs you money. You know, they forget to add a coverage you wanted, give bad advice, or mess up paperwork. You could sue them. This insurance helps cover their legal costs and any damages they have to pay. Things like accidentally not adding the right coverage, messing up admin stuff, saying the wrong thing about what a policy covers, not recommending the best type of insurance, but not things like intentionally hurting someone or, crimes. Those aren't covered.
So, a safety net for honest mistakes. Well, we've really gone deep today. It's fascinating how much law is behind what seems like a simple document.
It really is. And knowing these basics, from how any contract works to the quirks of insurance contracts to who the players are, it makes you a smarter insurance buyer.
As you think about all this, here's something to chew on. Knowing that insurance policies are those take it or leave it types, how does that change how you read them? Are there parts that seem unclear? And, based on all this, what could happen if you and the insurer disagree on what something means?
That's a great point.
Yeah.
And all this knowledge will be useful as you deal with insurance in life. It'll help you ask the right questions and really understand your coverage.